Good evening and welcome. We're delighted to see you all here this evening. My name is Simon Power and I'm the CEO of Fisher Funds, and it's great to see so many of you with us this evening. Thank you for joining us, and also welcome to the 1,000 or so people who have registered online to watch a live podcast of this evening's proceedings. Very pleased to have you here. Many of you are long-term Fisher Funds clients, and you might recall we usually hold these client events later in the year, and we still will. But it's been such an exceptional start to the year that we have added a series of out-of-cycle meetings across the main centres in New Zealand. And from my point of view, it's really important as the managers of your retirement nest egg that we front up and turn up during volatility. And so we're delighted that you're here. You trust us, and we take that trust extremely seriously. So there are two things that have marked the start of the year for our industry and business. The first, as many of you have mentioned to me outside, is the impact of President Trump's tariffs. And you're all here today, I imagine, because you've seen the impact of some of those decisions on your investments, and I know that you are keen to understand what happens next. So I'm very proud of our investment team and how they've responded to these events since the start of April. They are used to market corrections, though the political factors causing some of these corrections are new to all of us. The team have been in market talking to business, and tonight you will hear from some of our senior analysts who have been on the ground in the US and Australia, seeing for themselves what is going on in those markets. I must say, in my 14 months as CEO of Fisher Funds, I've learnt that investment managers are a fascinating breed. They are exceedingly intelligent and driven, highly motivated, and very thoughtful. In situations like this, they see the opportunity to buy stocks that have been on their radar and could benefit your investments. The second big marker for this year are the changes that have just been announced as part of the government's 2025 budget. These changes were well signalled, and we at Fisher Funds understand the government's motivation to balance the country's books, and it certainly, in our mind, makes sense to increase default contribution rates. However, New Zealanders will understandably be wanting to know what comes next over the medium term to ensure that that nest egg is available to them in the best possible terms at retirement. Just to have in the back of your mind while the team is talking to you tonight, Massey University research notes that the average couple living in a large city will need between $120,000 and $1.2 million, depending on the lifestyle that they choose, in the bank for retirement. And that assumes that they are homeowners and mortgage-free. So when the current average KiwiSaver balance of those aged between 61 and 65 is $69,000, you can see that we have a gap to close, and we need a clear national plan for the future. New Zealanders really do need that certainty and a 10-year roadmap, in our view, to be able to plan for those increased contributions. Our focus, though, in the meantime, remains absolutely clear: helping New Zealanders like all of you to build for a secure retirement. You have given us the responsibility of looking after your hard-earned funds to ensure that retirement nest egg meets your needs, and we at Fisher Funds take that responsibility extremely seriously. Our team of advisors all along the wall at the back there and in this corner here are available at the end of the event to answer any questions that you might have one-on-one. And with that, I'll finish by saying thank you again for being here, and I'm going to pass over to our Chief Investment Officer, Ashley Gardine, to guide you through your questions and our concerns and issues. Have a good evening.
Okay, well, thank you, Simon, and good evening, everyone. Welcome along to the roadshow. It's always great to be here with the home crowd in Takapuna, but also with people online tonight. So there has been an awful lot going on in markets, as Simon mentioned. It wasn't that long ago that we had Liberation Day. It didn't feel very liberating when I was watching my trading screen, but it was a big event. It caused a lot of volatility in markets. So what we thought we'd do tonight is talk a bit about that period of volatility. We'll talk about the trade war generally, but then talk also a bit about some of the dynamics that have led up to this trade war over the last couple of decades. Our investment team will also talk a bit about some of the opportunities that arose through this period. Markets did fall quickly. Whenever that happens, you have some companies that fall quite dramatically, others that hold up a bit better, and that gives you a chance to change portfolios. And then after we've done about a 20-minute presentation, we'll get a panel up on stage to answer some of the key questions we've had from clients over the last couple of weeks. But I thought I'd start off sort of back at the starting point, which is trade. And why is trade so important? If trade wasn't important, the markets wouldn't have been moving in response to these announcements. Now, trade is all about specialisation. Each country needs to specialise in what they're good at and trying to maximise production of that to trade for the things that they want and need. And when I was at Otago University studying economics, I had an interesting professor there that liked to use Richie McCaw and a lawnmower to explain the benefits of trade. And it wasn't immediately clear to me why he did that. But the story went basically that when Richie was All Black captain, he was extremely sort of fit, fast around a paddock, all very important things for mowing a lawn. And his bet was that if he put his mind to it, he'd be in the top 1% of lawnmowers globally. So then why doesn't he do that for a job? Turns out he was actually pretty good at something else as well. And not only was he in the top 1% of rugby players, he was in the top 0.001% of rugby players. And by spending his weekends playing rugby rather than mowing the lawn, he was able to make more income and trade for other things that he wanted. Someone else pointed to me last night that he's such a good guy that he probably mows his lawn as well. But the key thing here is, from a purely economic perspective, he would have been better off spending his weekends playing rugby and having someone else mow his lawn. And this is the concept that sits behind all trade, this concept of essentially figuring out where your comparative advantage is and specialising there, and trading, which is exactly what we do with the US. So you can see here schematically, this is a diagram of what New Zealand trades with the US. There are lots of things that we're really good at as a nation. Marlborough Sauvignon Blanc, making dairy products, high quality beef exports, perhaps tourism, backdrops for movie sets, lots of things that we're good at, but also some things that we're not quite as good at. Making jet engines, heavy machinery, the Boeing aircraft that we use to get tourists to New Zealand. We're just too far from manufacturing hubs, too far from supply chains to ever be a competitive manufacturer of those things. So as a nation, we're better to maximise our production of the things at the top there and trade them for other things that we need. And by doing that, we have more selection on both sides of the ocean and ultimately lower prices for everything than if we were to try and make everything and be self-sufficient. Now if we talk about tariffs, tariffs are essentially like putting a toll booth right in the middle of this diagram and charging a toll or a tax on the flow of goods back and forward. And essentially, in the case of New Zealand at the moment with this new 10% tax, it means there'll be an extra $800 million a year that producers have to pay in a tax to export goods to the US. And ultimately, because those taxes have been put on all nations, that will get passed through to US consumers in higher prices. So higher prices, a bit more inflation, and ultimately higher prices mean people can spend less. So a slowdown in economic growth. That's why people have been worried about the US economy over the last few weeks. But tariffs are nothing new. They've been around ever since we've had trade. And actually one of the most impactful trade acts was actually in 1930 when President Hoover introduced what was called the Smoot-Hawley Tariff Act. It was done for the right reason. It was trying to protect American jobs at the start of the Great Depression. They brought tariffs in of up to 60% on certain imports. But it didn't work out well. The impact was actually pretty swift and severe. Europe retaliated. Ultimately, trade between the US and Europe fell by 2/3 in 2 years. It had a real impact on US jobs and the US share market. So it really backfired. So I'm not sure what sort of Trump advisors got around this. They might not have looked at this period, or maybe they thought second time lucky. But the reality is we've seen this before, and this was why the market was quite concerned. But I think it's important to understand a bit more about the history as well, because throughout the 1930s, we saw a rise in nationalism. There was a severe economic impact from the Great Depression, and some of those things ultimately fed through into World War II. And the trade war we're having at the moment also has quite a lengthy origin, essentially. And you can see that in the charts here, going back to 1960, the US trade deficit in US manufacturing jobs. The US trade deficit really started going quite significantly negative in the early 1990s, which is the same time that there were economic reforms in China, and they really refocused their economy on being an export-led and manufacturing-led economy. So with this build-up of cheap manufacturing capacity, not just in China, but also other parts of Asia, we started to see this trade deficit expand, essentially. And as a result, the chart on the right-hand side shows that 30 out of every 100 Americans in 1960 were working in manufacturing. So in a factory somewhere, that's 8 out of 100 today. So we've seen this huge loss of manufacturing jobs in the US, and that's what President Trump was able to tap into during the election as well. Now, I think, though this isn't all bad, the reality is Americans like to consume. They've been able to consume more goods because they've been able to import them more cheaply from Asia. But also the loss of manufacturing jobs hasn't been too much of a problem. We still have really low unemployment in the US. And the reality is these jobs have been lost, but higher value-added jobs have been created in areas like services or software. So it hasn't all been bad. I think if this trend continues, though, it can create a problem. If, as a country, you lose all your manufacturing capacity, it can become problematic, particularly when it relates to things that are more important than plastic toys or iPhones. So it's not just about the iPhones, the war that we're having between the US and China. It is a bit broader than that, but really the crux of it comes back to the battle between US and China at the moment. China has over 200 times now the shipbuilding capacity of the US. So as a result of this change in economic policy, they've built up some really significant manufacturing, but also technological capability. They're also the largest manufacturer of electric vehicles, and BYD, which you can see there at the top, now outsells Tesla globally. So they've been extremely successful in industries like that. Also drones, they have the largest manufacturer of drones, DJI. And as we're seeing in Ukraine at the moment, drones are becoming a really important part of modern warfare as well. But the US still has really important advantages in certain areas. Technology is a good example. Aircraft, both Boeing and Lockheed Martin are hugely successful aerospace companies. And AI software and hardware, they have a lead there still as well. And a good example here would be NVIDIA, that make the chips that AI runs on, is a US company. But the other problem with that is they're actually manufacturing a lot of the chips in Taiwan now. So you can see where all this sort of comes together. And it hasn't just been President Trump that has been putting these tariffs in place. We actually saw during the Biden administration as well, there were increased tariff levels on China, particularly in these critical areas. So they were definitely more targeted under Biden, but things like electric vehicles, solar cells, critical minerals in particular, there's been this increasing barrier put in place between the US and China, particularly around these strategically important areas. So this has really been building for a while. It's probably one of the friendliest photos I've seen from the Oval Office recently. It's usually a bit more contentious. And that led us to Liberation Day, which really was a step too far for markets, a really big day for headlines, big day for market movements. And while everyone had expected this announcement, everyone in the markets were waiting for it, the tariffs were a lot bigger and broader than expected. So impacting every country, and not just a 10% tariff, in some cases 20, 30, 40% tariffs on some countries, particularly really big exporters to the US, like countries in Southeast Asia. And then at one point, the reason markets dropped quite significantly, when China retaliated, we had a short period there where it looked like there were going to be more than 100% tariffs between China and the US. So that would have put up a really significant barrier between the two largest economies in the world. So as we now know, that caused a lot of reaction in market. The movements were swift and severe. In 4 days after Liberation Day, we saw a 14% drop in the US market, which felt a bit like March 2022 when COVID hit. We saw similar, daily, really big daily moves in the market. And overall, from the peak in February to the trough at one point during April, the US market was down close to 20%. So there was a huge amount of volatility, which also creates opportunity. And what I wanted now to do is invite my colleague Matt up, and he's going to sort of zoom in on this in a bit more detail, but talk specifically about some of the opportunities that popped up in specific companies, but also then talk about that volatility in context so we can understand how that compares historically and what we can learn from that. So Matt, welcome up.
Yeah, good evening, everyone. So I'm Matt Logan, a fixed income portfolio manager. Where Ash left the chart was sort of pretty vertical line, fairly stressful. I know most of you know that subsequently things have rebounded from there, but I really wanted to sort of take you back into that moment because I think it's instructive to think about some of the things we were feeling there and some of the uncertainty that I guess was driving things, because I think it was maybe, in hindsight, obvious, but at the time, not so much. This is a chart of the VIX. It's a volatility index. You don't need to understand exactly how it's calculated. I think the notable thing here is there's two really big peaks. One is March 2020. We can all remember that. And the other one was 7 or 8 weeks ago on Liberation Day, and the sort of couple days after that. It's called the Fear Index. It's very aptly named. So what it does is it looks at essentially what the options market is pricing in for moves in asset prices. And so when things get going, this thing goes vertical. And it's, I would say, fairly surprising. And again, in hindsight, didn't seem like a pandemic level thing to be concerned about, but that's not what the VIX said. The VIX said, yeah, this is sort of like COVID. And so I think the Fear Index is a great name for it, because fear is, well, what is fear? I think maybe a horror movie, that's fear. What's the scariest part of a horror movie? It's usually not the end. At the end, it's kind of like, the sun comes out and maybe the monster's dead or something. For me, the scariest part of the horror movie is the very beginning, right? It's maybe that opening scene, and it's dark. There's something going on. We don't quite understand it, but you don't see anything. I'm pretty sure in Jaws, you don't see the shark till about 2/3 of the way through the movie. And it's sort of the same with markets. That's how fear works as well. When it spikes, it's because of uncertainty. We don't know what's happening. And so in that way, Liberation Day was a little bit like the pandemic. In the pandemic, it's long ago now. We're through it. But it's, I think, instructive to think, what were the scenarios that we thought might happen? Will the borders ever reopen? We're going to work from home for the rest of our lives. These sort of seemingly now kind of not silly things, but very tail risk event things, they were sort of happening on Liberation Day as well. Is Trump going to go, we just went to 100% tariffs, why not 200? He was probably thinking that, maybe even had the tweet there, right? And he was like, screw you, China, I'm going to do 400% tariffs. And the market was really genuinely concerned about this, right? We didn't know. This hadn't happened before. The monster was really scary. We didn't know what it looked like. And it affected stock prices. So the VIX is one thing. I care more about stock prices and returns. I think you do too. So US stocks, the S&P 500 again, down 19%. Closer to home, Australia and New Zealand stocks, not down quite as much. We're not quite in the firing line, but also impacted. Again, for us, we generally care more about companies. That's what we invest in rather than stock indexes. And so Costco, not seemingly in the line of tariffs. They actually domestically source most of their goods. They don't get too many from the tariff-affected regions, Asia. Still down 16%. That's a lot. And then the more tariff-affected stuff, yeah, you better believe it. So as Ash said, NVIDIA, they make those AI chips that he was talking about, strategically very important, down 37%. It's a pretty good bargain if you want to buy something, right? Or is it? Because who knows what's going to happen. Maybe NVIDIA's going to not be allowed to sell anything to China ever. Or maybe we're going to set up some new trade blocks, right? Trump's going to decide, who are the countries he likes based on sort of, bowing or bending the knee. So at the time, this was what we were thinking, right? And now, of course, we know the uncertainty didn't last. This didn't happen. So just as that fear kind of reached an extreme level, stock price movements was replaced, right? What was it replaced by? Well, I'm not going to do 400%. Actually, maybe I'll do a pause. Seems like now he kind of announces pauses almost at the same time as he announces the new tariffs, right? But we didn't know that then. We didn't have a sort of frame of reference. We couldn't analyze that. But over time, it's what always happens, right? So the myth sort of goes away. We can replace fear with analysis, reason, logic. Hopefully some other people maybe, get a word in with the tweeter-in-chief as well. And so where are we? Well, we're back to where we started, right? And it's really instructive, right? Because tariffs haven't started. So all the things we were worried about happening, none of it's really hit yet, okay? So we're not having to spend, they're all still paused, right? And so it's the sort of lifting of that fear and that uncertainty that's the main sort of mechanism that allows the market to repair. And that's not new. So I'm going to go from, talking about days to 50 years, bit of a jump. So this is the last 50 years of returns for the S&P 500. Average return is 10.5%, thereabouts. It's pretty good, I'd take that. But it doesn't happen every year. It happens, most years you get a positive return. You certainly get some big drawdowns. So the really big one, I'm sure everyone remembered 2009, terrible year. The tech bubble, those three there in the middle, that was quite a difficult unwind because it took a long time to sort of happen. And then March 2022 is quite obvious there, which was inflation-led. I think it's instructive that 2020 is not negative, right? So that was a fairly fearful time. And then I'm sure plenty of you remember 1987 as well. I challenge you to sort of pick out which bar that is. And it's because this is what actually volatility looks like. I don't think many of us just pick up the paper once a year and go, what's the return? Oh, good, okay, and then put it down. I'll look at it again next year. This is how we experience the market. These are the red dots of the maximum loss in each given year over the same period. This is how we experience things. Because I tell you what, these drive headlines. There's not many people who go, and headline S&P 500 returns 11%, get back to you, No, it's like S&P's down 30%, panic now. And so here you really see those events. All of a sudden 1987 really sticks out. It's the red dot just above the blue box there. 2009, again, right there. 2020 now sticks out. We can see towards the end of the chart down more than 30%. So this is volatility. This is how we often experience the market. But we get the blue ones, right? So it's kind of this strange paradox about what we can attend to versus what we actually receive. And so I would say the red dots is kind of like the price of admission for the blue bars. That's what you have to pay for. And frankly, it can feel a bit painful, right? And it feels like you're paying for it at the time. But it's worth it. So here's the same 50 years, S&P 500. This time looking at a time series, right? Over time, how much we earn. And here I've annotated it with some of those same events that caused a lot of those red bubbles. They don't look so bad now. The benefit of hindsight, we can see some drawdowns. Yep, Liberation Day certainly doesn't sort of stick out on this chart. And you might say, 50 years, it's a really long time. I wish I had that long to invest. But if you remember 1987, it's pretty much on the left-hand side of the chart, right? And so if that scared you out of getting out of stocks or staying out of the market, maybe going really conservative, it's understandable for sure, but you can see what it cost you. And yes, there's short-term volatility. You're going to get some red dot effects where you invest at the wrong time, and your return for that 1 or 2 or 3 or even 5 years is pretty painful. But over the last 10 years, been a 13% annualized return. Over the last 20 years, over 10%. Over the last 30 years, over 10%. So when you're in the market for a long time, the red dots start to fade away. Now, this chart didn't go up because of red dots or Trump tweets or COVID or anything like that, right? These are the events that just cause the volatility. Why did the stock market go up? Well, great companies, innovation, and earnings growth, essentially, right? The things that we're not talking about during periods of volatility. So to sort of turn the conversation on our head and kind of move on to what actually drives markets, where we've been investing through this volatility, I'm going to invite Sam Dickey up to have a chat.
Thanks, Matt, and good evening, ladies and gentlemen. So that was a really nice zoom out by Matt there to put that sort of irrational volatility in context. Now, Matt talked also about it's been a fantastic sort of few decades, 5 decades in fact, and that's been partially driven by trade, which Ashley talked about, which is critical. Richie McCaw's also critical, Ash, to our tapestry. But what's especially critical is innovation, and Matt touched on that. So we think the future's shaping up to be pretty exciting as well. So if we just take a quick step back here and we look back over the last 2 millennia or 2,000 years, for 1,800 of those years, economic growth didn't really move. And about 225 years ago, it really started to spike up, and that was because of innovation. So if you cast your mind back, it was the Industrial Revolution, it was the steam engine, the combustion engine, then you roll forward, it was computers and the internet. And the thing is that the pace of adoption is picking up as well. So when Alexander Graham Bell invented the telephone, he was probably a bit disappointed that we didn't really widely adopt that for almost 50 years. And now a technology is released and it can take weeks or days or even hours before it's widely adopted, like a viral technology like ChatGPT. Now on the screen here, you can see some of the innovations that are here right now or are coming in the near future. So you can see Amazon's drone up there, which delivers food and Amazon parcels around the US and eventually around the world. Top right there is NVIDIA's newest supercomputer chip called the Blackwell 200, extremely expensive chip that a board of those chips costs about $300,000. Humanoids that Ash talked about, autonomous vehicles, cell and gene therapy, eventually quantum computing. Now these things are coming thick and fast. They won't all take off, but having just got back from the US for 2.5 weeks over there, there are some things that are taking off right now. And the first one is robotic surgery. You can see in the bottom right-hand corner there. So in your portfolios, we own Intuitive Surgical, and we met management twice over there. And so how is that innovation going to drive economic growth for the next 100 years? The first thing is if you're a C- or a C or a C+ surgeon or student, using robotic-assisted surgery can you bring you up to be an A+ surgeon. So that means more supply of surgeons, more operations done more cheaply. Most importantly, better patient outcomes because these are safer, and that drives productivity and economic growth. The other thing we saw a lot of when we were over there was robo-taxis. So Waymo robo-taxis, and Google owns Waymo, and that's also in your portfolios. So how does that drive sort of efficiency and productivity and economic growth? These taxis operate 24/7, and they also don't take up our precious parking spaces. The final one was we spoke to Meta when we were over there, and this is a little bit more edgy, but they're convinced that we're going to consume our information and our artificial intelligence differently in the future. So instead of looking at our phone all day, we're going to consume it via a pair of Ray-Ban sunglasses or clear glasses with a heads-up display. Now that sounds a little bit edgy, but when you consider the average human picks up their iPhone 58 times a day, what's less insane? You can be walking along Lambton Quay, checking your messages, getting a heads-up display on your next meeting notes, and all the while looking a little bit cooler than looking down at your phone. So what have we been doing? Matt mentioned this, that when we see this irrational volatility, we see it as an opportunity. And the reason we have that confidence is A, the trust that you place in us to be able to take that long-term view. And secondly, the first thing we do, like we did in COVID, like we did in the global financial crisis and the European financial crisis, is we triage our risk. So, for example, the worst impacted companies by the tariffs would be a company that manufactures T-shirts in Vietnam or China and exports them all to the US. So that'd be the worst case scenario. Now we don't have any of those T-shirt manufacturers, but there is a spectrum. So once you've triaged your risk, you can play offense. And we did that via two ways. The first thing we did is we took advantage of the fear in the market, and we bought companies that were partially impacted by the tariffs, but we thought the market had overreacted. And the second thing we did was we bought companies that weren't even impacted by the tariffs, but the market was in such a fearful state that those companies had been bought down as well. So specifically at Fisher Funds, we mobilized hundreds of millions of dollars, and we started to buy these type of companies. So again, that first bucket is companies that were impacted and will be impacted by the tariffs, but the market had overreacted. So a good example there is Amazon. So as Ash said, if you think about that toll booth, Amazon will be impacted by that toll booth because it imports product from Asia and China and around the world, and therefore it would be passing on that increased cost that it gets from the tariff toll booth to its consumers, and investors were concerned that that would lower the demand for their goods. Now, our view was the market had forgotten two really important things. The first one is Amazon was going to be at least as well off as its competitors because it can use its scale to drive down its own cost base. But more importantly, 60% of Amazon's profits come from its cloud business, its Amazon Web Services business, which was not impacted by the tariffs. So we took advantage of the opportunity there. The second bucket is, and these really are ultra high quality companies that often trade quite expensive, but given that the level of fear that was in the market, I mean, Matt showed that VIX chart. If you actually take that back 25 years, it was amongst the most fearful the market has been in a quarter of a century. So the whole market was getting sold around that sort of 7th, 8th of April period, and we bought companies like Costco, which is one of the highest quality companies on earth. They are myopically focused on their customers and going to work every day to mobilize their scale benefits to drive down the cost of their high quality products. And I'm not sure if any of you have been out to West Auckland, but Costco's got some great products out there. So that company was 20% cheaper than it otherwise would have been just because of the general fear in the market. Now, as Ash mentioned, the tariffs were broader and higher than we expected. So in the right-hand bucket, we did take some risk off the table as well. So companies like Floor & Decor, which were right in the firing line, we did sell some stock there as well. Now, Matt and the fixed income team were equally busy during this period. So when this perceived or actual trade war drove down equity prices, it also drove down bond prices. And Matt and his team were well positioned to lend money to some of these high quality corporates up here at more attractive yields than they had been the week before. So if we take Dell, for example, among other things, they manufacture computers in China and export them into the US. So the price of those bonds went lower, the yield on offer went higher, and Matt and his team took advantage of that. So in summary, Ash reminded us why trade is critical, why Richie McCaw is critical, and why that shock drove down stock markets. Matt nicely zoomed out and put that fear in context, and hopefully I've shown you why we're optimistic about the future and why we were well positioned to take advantage of those opportunities that fear presented. Now I'm going to invite Robin Conway up on stage, our General Manager of Managed Funds, to ask us the questions that all of you have put into the pot to ask the three of us, or four of us. Please.
Thank you, Sam, Ash and Matt. It's been great hearing from you all and getting some insights on what we're doing and considering from an investment perspective at Fisher Funds. As Sam mentioned, I'm Robin Conway, GM of Managed Funds, and I have the privilege of working with all the advisors in our business, many of whom you know very well. Now, as we move into the panel, I'd like to invite you all back up on stage, as well as one of our wonderful senior wealth advisors, Louise, and we will get into some of the questions that you've asked. So we have summarised some of the questions that everybody has sent in, but we will also be available to answer any questions after the fact if anyone wants anything specific answered. So Sam, this first question is for you. One of the most common questions we're getting is if the era of US exceptionalism is over and if Kiwi saver balances are too exposed to the whims of the US government. What's your view on this, and should we be investing less in the US and looking for investments in other markets?
We're getting asked that a lot at the moment because of the volatility in policy making in the US, not just from investors in New Zealand, but when we were in the US for 2.5 weeks, even US-based investors are wondering whether they should be diversifying outside of the US. So the first thing is, I guess, what is this term US exceptionalism? And it's the concept that the US economy, and especially the US stock market, can outperform the rest of the world for long periods at a time, and it has done that. So if you look back for the last 20 years or so, the US stock market's up around 600 or 650%, and the rest of the world, ex the US, is up about 250%. So two questions there. Why is that, and is that changing? Why is that is firstly because of real capitalism that drives innovation. So, investors and entrepreneurs in the US are not encumbered by unnecessary regulation, and they're taught that if they work hard and put risk capital to work, they'll be paid off many times over. And that's really driven that sort of flywheel of innovation in the US, which is more prevalent than anywhere else on earth. The other thing is, I guess, it's one country. It is a democracy, last time I looked, despite some of the conversations I've had here tonight. And it's afforded the luxury of being the world's reserve currency. So we don't think any of those things are really changing. We think some of those things are being put into question. And when we sort of hear those questions asked in a mildly hysterical tone when I was in the US, I think we thought that was an opportunity. But one thing I will say, though, is this has been a very US-centric presentation, but we invest in companies all around the world, and we've been buying some of those today and taking profits in those same US companies, which have rallied sort of 35 or 40% in short order. So we're not focused on one particular country. We're really building the portfolio from a bottom up and looking for companies with wide economic moats, long growth runways, and run by fantastic people.
Thank you. Ash, moving to you. If we move away from international markets for a moment, why is the New Zealand economy so sluggish by comparison to the US and Australia? And when might we see a recovery?
Yeah, it definitely has been a lot tougher here than the US, and I think it's a good reminder as well why diversification is really important. A lot of Kiwis do have money offshore in foreign shares, and that's worked out really well, even though our market's been a bit weaker. But our economy's been weak essentially because we have a really large property market, a lot of reliance on property as an investment. People have a lot of mortgage debt as a result of that. And when we had this bout of inflation, which we saw all around the world, central banks had to react by increasing interest rates. But New Zealand turned out to be a lot more sensitive to interest rates than other parts of the world. In the US, a lot of consumers there or borrowers have really long-term fixed mortgages, so they weren't quite as impacted as we were here in New Zealand. And then in Australia, the Reserve Bank of Australia didn't move as aggressively as the Reserve Bank did here. So as a result of the Reserve Bank moving early, but also more aggressively, that's definitely hit us here. I think a couple of other things. One is tourism. It's a bigger part of our economy than it is in the case of the US, for example, and we're still not fully recovered from COVID. And when you take those two things together, it's resulted in a weak economy and less people wanting to come here, so less immigration. I think at the same time, though, economies really importantly have some self-correcting mechanisms, and one of them is the currency. So the currency's come down quite a lot. That's starting to benefit our farmers and our exporters, so that's great. We'll start to see a bit of a boost as there's more money in the rural economy. And then the second thing that helps is interest rates come down, and we saw again today the Reserve Bank brought interest rates down further, but mortgage rates have come down pretty significantly over the last 18 months, and that will gradually feed through to people's pockets. So over the next 6 to 12 months, I think we'll start to see a pickup.
Pleasing to hear, thank you. And that moves nicely into my next question for you, Matt. We have a new Reserve Bank governor in New Zealand. What could that mean for interest rates and the economy?
Yep, we do. And sort of today was his first big day, as Ash said. So there was an OCR announcement today, dropped 0.25% to now 3.25%. Yeah, fair bit lower than where we were sort of last year when we were at 5.5%. The short answer is the institution is probably more important than the person. Having said that, Adrian Orr did resign unexpectedly and very quickly, so there has been a little bit more attention on that than you would normally see. I think today, not to get too deep in the weeds, but he did a good job of sort of, there's a press conference after the policy announcement, and he did a good job and sort of played a pretty straight bat, as you would expect. The thing as a fixed income manager I'm most concerned about, or I'm always concerned, I'm a bond manager, sorry, is where the OCR sort of ends up, where the bottom of the cycle is going to be. So 5.5 was the top. Is the bottom going to be, some economists still think maybe 2.5%, so a fair bit more cutting, whereas others maybe think maybe only one more cut from here, so sort of 3%. So that tells you that the RBNZ, and to a certain extent the market, is aligned with Ash's view that probably next 12 months we should see the impact of that lower borrowing cost. I'll say the other maybe less well-known thing is we might get a bit of tailwind from regulation as well. Adrian Orr had a fairly difficult relationship with some of his colleagues at the Beehive. One of them was around the way that he was going about stress testing banks. Again, don't want to get too deep in the weeds, but please come and talk to me afterwards, please. No one will. About banking regulation, how much capital they have to hold, right? And so the more capital they have to hold, the less they can lend to businesses and for mortgages. So I think there's probably going to be some shifting in tone, and they have a sort of review underway for that as well. So that could be, fingers crossed, another sort of tailwind for the economy.
Sounds great, thank you. Louise, this one's for you from an advice perspective. The recent market conditions have tested clients and how comfortable they are with the market. For those clients who have found the recent tariff turbulence unsettling, what should they be doing?
Evening, everyone. Talking to us, we want to hear from you. That's what we're here for. I want to just really go through the main things that I would like to cover off in that type of conversation, because when we get a call, usually it starts with a question: should I be worried? Should I be doing anything? So those three things really that I think are important to cover off. The first thing is, what's made you pick up the phone today? We shouldn't always assume that it's just what's happened to their portfolio. It may be a bigger picture, especially when people have been invested for a long time. If we look at the impact of the last couple of months, to fall in a balanced portfolio would have gone down by about 8%, just over 8%. That's not unexpected. So when we get a call, I want to know, maybe there's some other things that are going on that are putting some strain in your planning. It might be a relationship stress, it might be job uncertainty, it might be a health scare. So that's important for us to understand what's made you pick up the phone and is causing that anxiety. The second thing I want to know is, what is the actual impact of that fall? So if you had $100,000 invested, what would have happened from the height of mid-February through to the low point in April? That your portfolio is now at 92,000, something like that. So what is the actual impact of that on your life? Is there something you've got planned for the future that is now in jeopardy? Maybe things have changed. Maybe you do have some short-term expenditure that we need to think about. And then the third thing is, having gone through that phase or conversation, is talk about your options, because you will always have options. It's not a matter of being fully invested or completely out. Everyone's got three levers, and we want to be informing you of what those levers are and giving you the power to make changes if need be. So everyone's got cash, a cash buffer, money in the bank that's outside your portfolio. You've got the strategy that you've decided within your portfolio, the mix of shares and bonds. And the third thing you've got that's a lever or a valve to dial up or down is your regular contributions or your regular drawings that you may be making. So those are three things that we can work with. So, we do want to hear from you, and there's plenty that we can do and talk about through these times.
Thank you. To get a bit more specific, one client has asked how they should handle the volatility as they are in retirement. It's been incredibly unsettling. And watching funds move around, should a client in that situation move from a more balanced investment to something more conservative?
It really depends. I don't like making any generalisations about people in retirement, because you can be retired from a period from 10 years to 30 years with quite distinct phases within that period. So I'm not going to make generalisations about a strategy which is right and wrong. I would make a couple of observations though. From my experience, having been an advisor for a while, a period where people are very sensitive to volatility will be in the couple of years before they retire and a couple of years afterwards. There's some massive changes going on in your circumstances. The income tap's been turned off, and probably for the first couple of years you don't actually know what your new life is going to be, let alone what it's going to cost. So I would say that at that period of time, you're also at maximum wealth. That's probably the most money you're going to have ever had in the bank or invested and will ever have in the future because you'll start spending it. So, that's a crucial time. The other side of when it comes to risk and managing it within retirement would be the other end of the spectrum where you may be in your mid-80s and have quite an established lifestyle and cost of living. But I often hear when we talk as an investment team about stick around for the long term and ride out the ups and downs, I'll hear the comment, well, I don't have the time. So, we need to be really aware of that. And I'm not saying don't take risk, but to be very deliberate about your investing plan. And it comes down to two main questions always. What's the money for and when do you need it?
Fantastic. Thanks, Louise. Sam, if we ignore the headlines and the market movements for a minute, based on what we've seen so far, what will the actual economic impact of these tariffs likely be?
Yes, headline whipsaw, I think it's been called. But I think the answer is initially economists thought the impact would be quite a bit, but they're sort of walking back from that now. So immediately post-Liberation Day, people thought there'd be a growth impact and an inflation impact. So the growth impact would be because consumers like us and businesses in the US and around the world would sort of sit on their hands amidst uncertainty. So the US was at that time was probably growing about 2.5%, and people thought it might flirt with recession in the second half. So maybe sort of 0.5% growth. On the inflation side, because of Ash's toll booth that he was talking about, and the fact that would be effectively importing inflation into the US. I think inflation at the time was running around 2.5% in the US, and maybe that would spike to sort of 3.5% in the second half. Now, what I can tell you from being over there real time is so far so good. And the way we looked at that was sort of two real-time great indicators on the economy. The first one is MasterCard, which we own in your portfolios. And they have a great bird's eye view of the US consumer, but also the global consumer. And as at late April, early May, they were seeing no slowdown in consumer spending. The second one was that the rail companies that we own in the property and infrastructure portfolio, and Warren Buffett famously said, if he was going to go onto a deserted island for 6 months, what's the one data point he would take with him to understand how the economy is ticking over? And that would be sort of weekly rail cargo data. And the rail companies are saying, again, as at the end of April, early May, no slowdown. So the final thing was the companies we met over there, the dozens of companies, they have not yet seen that inflationary impulse come through their cost base. So far, so good, but we're keeping a very close eye on it.
Very interesting, thank you. Louise, how should clients change their drawings approach during a period of heightened volatility like we've seen this year, or perhaps in a more prolonged downturn like we had in 2022? If they're in retirement, do they need to withdraw less per month, perhaps?
Just to talk a little bit about how we do projections and run scenarios as advisors. Let's take a balanced strategy as an example. We will plug in an expected rate of return after fees and taxes of 3.5%. Now that is a conservative estimate, but you're not going to earn an average, yes maybe, but you're certainly not going to earn returns of 3.5% every year of being invested. You're going to have some great years of double-digit returns and some years of negative returns. But that 3.5 accounts for all of that. So you shouldn't actually, if you've made a sustainable plan of what you can take sustainably over your retirement, you shouldn't have to tighten your belt in a negative year. That's built into the expectation. Having said that, there are a couple of things that I did want to just point out. Going back to that scenario where you're at maximum wealth early in retirement, if you do get a couple of negative years back to back, the impact of that can be greater than if you get a couple of negative years mid-retirement or late retirement, because your balance is that much bigger. So when it comes to the planning, that's where it's important. I'd say two things you can do to mitigate the risk. The first thing is to identify your spending needs from must-have to would like to have. So you'll take the regular drawings, but in times where perhaps you have had a really rough year, you've got some flex there to potentially not have that extra holiday or update the car. The other thing to do would be to have a cash buffer and use that buffer in a way where you can draw on it rather than sell units in your funds for a period of time. And in the good years, perhaps top up the buffer, and in the bad years, you can spend it. So those are just a couple of examples that can help during these times when you're drawing on your money.
Thank you. Matt, what's our view on fixed income investments? It's been a tough few years for fixed income investors, but with share markets having rebounded in recent weeks and term deposit rates having come down over the last year or so, is fixed income starting to look attractive again?
Yeah, I mean, I'm the fixed income portfolio manager here. I feel it's always been attractive, hasn't it? No, I mean, yeah, the period of inflation, 2021 and 2022 was rough, right? It led to much better times. So actually, fixed income returns have been pretty good for the last sort of 12 to 18 months. And you probably have experienced that yourselves with some better TD rates, right? So last year, over 6% for 1 year, kind of no-brainer, right? That was pretty nice. Now we're kind of under 4, so it starts with a 3. So after tax, oh gosh, that's maybe not so good. So relative to that, I am feeling pretty good. I get to look at a global selection of corporate bonds, go out there and sort of lend money to some great companies. Dell, you probably heard of. Trade Me, I probably spend a bit of time on there as well. And so in that range, I'm seeing some pretty good returns. They're not, Sam gets to talk about all the really juicy returns, but I'm pretty happy with 5 or 6% yields and returns. And so, yeah, and on that basis, particularly when we've had some pretty volatile markets and I'm looking at how my funds are performing, yeah, I think it's stacking up pretty well.
Great to hear. Ash, with markets having largely recovered in recent weeks, but the trade situation not fully resolved, how do we see the balance of risks from here?
Yeah, I think we're learning to expect the unexpected at the moment, and we have seen a big rebound in markets. So the market's sort of almost assuming that the trade war's been dealt with. The reality is we know that we're just on a pause. So what we really need to see, I think the market's quite happy though that there are negotiations happening and we're not going to have the worst case scenario that Matt pointed out. There's going to be some medium, so the market's taken a lot of comfort from that. But we do need to see a resolution to all these negotiations. We've got all these pauses for different countries. Over the next 90 days, we want to start seeing a landing on tariff levels and what the frictions will be, because then countries and companies can start adjusting their supply chains and we can start figuring out what does that mean for inflation, what does it mean for growth. But the worst case scenario seems to be taken off the table, so that's a real positive. The other thing is we do want the resolution to come reasonably quickly, because the longer this all drags out, the more risk there is that people hold off on spending, travel, businesses hold off on investing. So that's the other thing. If this drags on for too long, we might start to see a weakening economy. So I think it'll be volatile, and actually in the last Trump administration we had 3 significant downturns, but over that whole period we still had, the market was up close to 80%. So we're positive on the outlook and we'll try and take advantage if there is more volatility.
Great, thank you. Now that does wrap up the questions that we've got for the evening. As we mentioned, if anyone does have any specific questions that they would like answered, then we are more than happy to have them answered after the fact. Before we wrap up, I'll just hand back to you, Simon.
Thanks, Robin. I won't speak for long other than to say I hope you've found that useful. Our advisors are all across the back of the room here. They're available to you if you want to have a one-on-one conversation with them either tonight or at a time that suits you. I want to just thank you again for coming out tonight. It's our job to make sure that when things are a bit uncertain, when people do need reassurance, that we're here to answer those questions. And I just want to conclude by saying thank you for choosing Fisher Funds. Enjoy the rest of your evening.